Let's see. Discord. Don't save. Video of me. Let's see. Okay, it's frozen. Nice. Turn off camera. Okay. Oh, wait, I need to change this. There we go. Okay, nice. No. Okay, welcome back, guys. Stream set up officially. So, kind of want to go over today. I was just looking at some WSO articles, but wanted to go over a few. We'll call them. Damn, there's a lot. I have a lot in the pipeline in terms of earnings recaps. Cisco, Intel. So it'll be interesting to kind of actually get some of these posted. Yeah, get some of these posted and just keep chugging along. So Cisco's definitely backed up. I think today there's actually a decent amount of earnings. So Walmart definitely released. Let's see, Live Nation. I think there was an interesting, so EPAM. Okay, Akami Technologies. I actually am interested in that. Unity Software. Curious to actually. Dropbox stock. Unity Software stock. 30%, Jesus. Okay, this is actually very interesting. $7, wow. So something happened here. Maybe, okay. Oh, Alklo. 5.9. %, okay. So this is, from what I remember, kind of the contact center as a service. TripAdvisor, Dynavax, Innodata. Okay, so I am more curious about Akami technology. So let's see, stock. Because from what I remember, this is kind of the content delivery network platform. And it'll be interesting to kind of see what this is. Akami Technologies. Akamai Technologies Q4 2024 earnings recap. Okay, so let's go into Akamai earnings release. So revenue of $1 billion fourth quarter, so it's a $4 billion annual run rate, which is pretty similar to actually if you look at Confluent, Elastic, these enterprise software companies. But I'd imagine this is more so of like an infrastructure type company. When adjusted for foreign exchange, security and compute revenue represented 69% of total revenue in the fourth quarter and grew 16% year over year, 70% when adjusted for foreign exchange. GAAP net income diluted per share of 91 cents, down 12% year over year, down 9% when adjusted for foreign exchange, non-GAAP. Revenue of 3.9 billion, okay, so this is basically 4 billion, 5% year over year, so it's not a super fast growing business. Security and compute, 67%. I wonder what the other one is. Cybersecurity and cloud computing, that, okay. So yesterday, we'll call it Akamai, probably, technologies, reported fiscal year Q4 fiscal year 2012 earnings yesterday, on February 20th, 2025. Okay. On Thursday, for the months, for the period beginning September 30th, 2020, call it October probably, October 1st, 2024 to December 31st, 2024. Akamai Technologies is a cybersecurity and cloud computing company that is, I could be mixing up Akamai with Cloudflare, but I'm 99% sure that Akamai is known for their content delivery networks, CDN. This quarter was the first 4 billion. I believe this quarter marked the first time Akamai reached over $1 billion in quarterly revenues. With 69% of their total revenues coming from the security and compute segment business. Okay. So there's three different security revenue, compute revenue, delivery revenue, up 3%. So about half of the business is in the US, other half is 490 million in international. Okay. GAAP income from operations was 148 million, so it is profitable. I think this business has been around for a while. 20% decrease from fourth quarter 2023. 50% 15%, down 4% from same period last year. Okay. So I wonder why that is. Supplemental cash. Exclude certain items that occur infrequently, which are also inherently difficult to predict and estimate. It's difficult to predict the tax effects of the items that Accounting excludes. Okay, material changes, quarterly conference call, 4:30. That's about 30 minutes in. So cost of revenue, I'd imagine gross margins is about the same. 3 months in. Okay, never mind. So this is not the first. Mark the second. Period. Straight period. Where Kami generated over quarterly revenues. So it does seem like R&D, sales and marketing, amortization is okay. Restructuring, if you look year over year, yeah, restructuring was the larger expense. 11,000. Okay, so cash flows. So depreciation is increasing. SBC, benefit for deferred income taxes, amortization, other non-cash reconciliation items. So 30. So this is about 20 million more, but this is 40 million more. So the extra 20 million. Accounts receivable, they actually did collect a lot. No, I guess they booked more in revenues that they haven't received or collected. Okay. Cash flows from financing activities, proceeds from borrowing under revolving credit facility. Okay. Issuance of common stock under employee plans. Employee tax related, paid to net share settlement of stock-based rewards, repurchases of common stock. Okay, growth year over year, revenue by geography, CapEx. So it does seem like this is actually a pretty capital intensive business if they're spending 19%. Income from operations, legal settlements. Okay, income, restructuring charges, scope of business. These charges include severance. Okay, so I'm going to open up Akamai webcast. Let's do Zang Fund.
Operating margins. For 2025, we are estimating a non-GAAP operating margin of approximately 28% as measured in today's FX rates. Decline in operating margin for the full year 25 is due mainly to depreciation expense being approximately 90 basis points higher than last year and the negative impact of foreign exchange year over year. We anticipate that our full year capital expenditures will be approximately 19% of total revenue, up approximately 2 points from 2024 due to the items that I listed earlier. As a percentage of total revenue, our 2025 CapEx is expected to be roughly broken down as follows. Approximately 4% for delivery and security, approximately 6% for compute, approximately 8% for capitalized software, and the remainder is for IT and facilities related
web applications.
Moving to EPS. For the full year 2025, we expect non-GAAP earnings per diluted share in the range of $6 to $6.40. This non-GAAP earnings guidance is based on a non-GAAP effective tax rate of approximately 19.5% and a fully diluted share count of approximately 152 million shares.
Network.
Before closing, I want to comment on our revenue and profitability goals for the next 3 to 5 years. Cloud infrastructure services is experiencing significant growth, which we believe will be the main driver of our total compute revenue in the near to medium term. Our goal is to grow total compute revenue at a compounded annual growth rate of approximately 20% over the next 3 to 5 years. Moving to security. Given the size and scale in our security business, it is natural that we will see some products reach maturity and experience slowing growth rates, while other products in emerging areas will see more rapid growth. As a result, we expect security growth over the next 3 to 5 years to be led mainly by our newer Guardicore platform and API security products. However, some of our largest security products, like Web Application Firewall or WAF, and Prolexic, are examples of some of our more mature products. We've been offering these products for over a decade and have reached a very high penetration rate within our customer base. As a result, we expect the growth rate for these products to begin slowing in 2025 and continue to moderate throughout the remainder of the decade. Given these dynamics in our security portfolio, our goal is to grow total security revenue at an overall compounded annual growth rate of about 10% over the next 3 to 5 years, including our typical level of M&A. We anticipate delivery revenue declines will moderate in 2025, with increasing stabilization expected over the next few years. In summary, we anticipate that the combination of double-digit growth of our security products, the rapid expansion in our compute services, a stabilizing delivery business, and a continuously improving product mix away from delivery will allow us to achieve double-digit top-line revenue growth by the end of the decade, if not sooner. As for profitability, we expect operating margins to reach 30% plus by the end of the decade. And with accelerating top line and expanding operating margins, our goal would be to deliver strong growth in non-GAAP EPS over the next few years. Finally, when we're not providing specific guidance for 2026, we do anticipate revenue acceleration and margin expansion compared to 2025 levels. With that, I'll wrap things up, and Tom and I are happy to take your questions. Operator?
We will now begin the question and answer session. To ask a question, you may press star, then 1 on your telephone keypad. If you're using a speakerphone, please pick up your handset before pressing the keys. If at any time your question has been addressed and you would like to withdraw your question, please press star, then 2. At this time, we will pause momentarily to assemble our roster. The first question comes from Roger Boyd with UBS. Please go ahead.
Great. Thank you for taking my question, and congrats on the quarter and congrats on the large cloud deal. Tom, I'd love if you could maybe expand a little bit on that, provide any more details on the nature of workloads this customer is bringing over. And it sounds like it's probably coming off a hyperscaler, but any additional info you can provide on the competitive environment there as it relates to pricing, performance, edge presence. I think Ed noted there's some geo-specific conditions the customer is looking for. And I know that's a lot, but thanks.
Yes, they already have been using substantial cloud infrastructure services at Akamai for a variety of media applications and will increase that usage. In addition, they have some special needs in Scandinavia, and we are building out a data center there for them to handle substantial applications for them throughout Europe. So they're using the services in a normal way, plus we have a special situation that we're doing a build-out for them and development for them that ultimately we think many of our customers will use.
Super helpful. Appreciate the call.
The next question comes from Madeline Brooks with Bank of America. Please go ahead.
Hi, team. Thanks so much for taking my question. First is for housekeeping. I just wanted to clarify that the $100 million compute deal is not the same as the 5-year deal that you signed with your largest delivery customer, and then I have a quick follow-up to that.
They are the same customer.
Got it. Okay, thank you. And then the other one, too, would be, can you just give us more details outside of just the geolocation on why they chose Akamai? Does it have anything to do with maybe newer products that you have, work on AI or intelligence, things of that nature would be helpful? Thank you.
Yeah, they chose Akamai for superior performance and better pricing. We are very well connected throughout Europe. Nobody has the points of presence that we do. And so we can handle requests for this customer throughout the continent and get it into the data center facility they'd like to have in Scandinavia, and do that very efficiently at a favorable price point because of our existing platform and capabilities.
Strong.
The next question comes from Amit Daryanani with Evercore. Please go ahead.
Yep, thanks a lot, and thanks for taking my question. I guess I have two quick ones, hopefully. The first one, with your largest customer, the $60 million headwind that you talked about, I'm hoping you just maybe expand a little bit on that. Is that headwind going to happen irrespective of what happens with the recent executive order around their operations? I'm just trying to understand, is this more about them intending to move some of the CDN in-house, or is it more from the executive order? So that $60 million headwind, does it happen irrespective? And sounds like it's another $60 million in 26. Maybe we just level set that, kind of what's happening there, how to ring fence it. That would be helpful. And then, just a question, operating margins. What do you think it takes for Akamai to get back to a 30% operating margin number over time? Any kind of help on revenue or cost control would be helpful. Thank you.
So the headwind is by and large because of their DIY build-out, as we talked about. So they'll be taking on more of, the services themselves. And there are, political challenges, obviously, in the U.S. as a result of the 5-year agreement. Our exposure there is mitigated quite a bit. As we talked about in a disclosure last year, we had about $50 million, have about $50 million of U.S. business with this customer that obviously would be taken away if they are banned in the U.S. However, as a result of the minimum commitments made, our exposure there is less. As Ed pointed out, if they are banned in the U.S., then we would have less revenue from them than if they continue to operate. And if they continue to operate, there would be upside and to the upper end of the range. And Ed, do you want to talk about the margins?
Sure, yeah. So mostly the expansion is going to come through two things. One, the mix is going to move more towards security and compute. And then just from an operating leverage perspective with the revenue growth, we just believe we can scale the business accordingly. And a lot of that additional growth will drop to the bottom line. The changes that Tom's talking about or mentioned on the call about go-to-market, some of that's already been funded by the action that we took before, and we'll be very responsible with future investments. So we expect to see some scale as we grow top line.
Responsible.
Great, thank you very much.
The next question comes from Fatima Boolani with Citi. Please go ahead.
Oh, good afternoon. Thank you for taking my questions. Tom or Ed, please feel free to chime in on this. With regards to TikTok, you talked specifically about the delivery business and some of the minimum commitments they've made to you to protect you. But I was actually curious if you can opine or comment on if that is a customer that has adopted other solutions in your portfolio, i.e. specifically anything in the security realm that we have to be mindful of eroding away. And then I have a quick follow-up on the go-to-market as well.
Yeah, like any large customer, they pretty much use all our services. So they're a large delivery customer. They use a lot of our security services, and actually a growing amount of our cloud infrastructure services. And we have factored that in to the guidance we've given, both the guidance for this year and the 3 to 5 year guidance.
Great. And just from a go-to-market perspective, Tom, you were very explicit in that there's been, a lot of thoughtful change and maybe a little bit of an overhaul in the go-to-market organization by way of account segmentation, pricing strategy, et cetera. I'm wondering how far along are you in the process of ironing out or cementing a lot of these changes? Because it does seem like there might be a couple of things in flux from an aggregate go-to-market strategy perspective. So would love to hear kind of where you are on the journey to kind of overhaul the go-to-market organization and how we should think about you coming out the other end of that. Thank you.
Yeah, great question. Think of this as sort of a 2-year process, roughly speaking. And, we're in the beginning stages. We've already, increased the number of our hunters, and as I said, the ratio of hunting to farming. We've already increased and will do further increases in the specialized sales team. We are working now, thinking through pricing structure changes, potential contract, structure changes, making progress in, segmentation, for the field. So a lot of work still underway. And you want to, I think, position this in the context that, we're transforming the company. And you look at our product set, and we're evolving substantially from what was a delivery company and then a delivery and, say, web app firewall company, where most of our revenue has been. And you look at the products that are really growing and driving us forward to the future, and you're looking at, Guardicore segmentation, enterprise zero trust security. You're looking at API security, huge green field there for us. And, best of all, you're looking at, our cloud infrastructure services, which are just really taken off. It's remarkable, I think, when you see what's happened. We bought Linode about 3 years ago, had about $127 million ARR, growing mid-teens at best. And today, more than double, now growing at 35% last year. And we're forecasting 40 to 45% this year. And, I think what's really exciting about that is the addressable market for us is literally over $100 billion. And that's probably just in our current customer base. So tremendous potential, and it's really taking off now. So that changes the company, and it changes what we need from the sales force, what they need to be doing. Obviously, we want to, protect and grow the revenue in our existing base, but we want to be out there selling those new products, both in the existing base and to a lot of new customers. And so in response to that, we're in the process of transforming, the sales force, to get, the capabilities that we need to continue, the very strong growth we're seeing in these new areas.
Thank you.
The next question comes from Frank Louthan with Raymond James. Please go ahead.
Great, thank you. Can you give us? Let's see. Can you give us an idea of what the logo growth was in the quarter? That'd be great. And is there any particular groups, security, compute, et cetera, that saw better or worse growth from new logos? Thanks.
Yeah. Hey, Frank. This is Ed. Actually, logo growth obviously was probably most positively impacted from the Edgio contracts that we acquired. We added a few hundred logos there. Over 100 of those were new to the company, so that was the biggest addition. As far as where the new logos are coming from, it's mostly in security in the two new areas that Tom talked about, Guardicore and API security, and also in the compute side as well. So I would say it's probably stronger than normal new acquisition quarter in Q4, just normal course, and then obviously Edgio helped quite a bit as well.
And what's your outlook for being able to retain those Edgio contracts? Do you think some of those will churn off, or what's the likelihood of those converting into more permanent customers?
Yeah, so we've gone through the migration at this point. So we've moved everybody off. The Edgio network is closed, or shut down at this point. So we have a good idea of who's come over at this point. We don't anticipate significant churn from what we have today. We are very selective in what we took. We didn't take all the customers. There were certain things, certain small customers that didn't make sense for us to take. There were some acceptable use policy violations that we wouldn't take, and there was some economics with certain customers that we didn't want. So, factored into our guidance is what we think we'll do with that customer base. I think there's probably some upside there with upsell, Generally speaking, you want to land the customer, make sure they're happy, and then start, developing a pipeline with them. You don't want to just attack them right away with the sales pitch. So, pretty happy with what we were able to retain. It was pretty much right in line, maybe a little bit better than we expected.
Okay, great. Thank you.
The next question comes from Rishi Jaluria with RBC. Please go ahead.
Oh, wonderful. Thanks so much for taking my question. Just two quick ones. First, going back to some of the changes in go-to-market and changes in sales, what can you do on your end to minimize the disruption from that? What are you assuming when you think about your 2025 guide? And I ask because in the history of software, we see sales reorgs, changes to go-to-market, and they always end up being a lot more disruptive than anticipated. So maybe if you could walk us through your assumptions and what you can do to minimize that disruption, that'd be helpful, and I have a quick follow-up. Well, the first key is to avoid account breakage, and so we're not doing it all at once. As I mentioned, this is a 2-year journey, and of course, we're adding resources with specialization in the new products, and so those folks are, helping do the cross-sell and have a chance to hunt for new customers. And so the key really, I think, is we will minimize the breakage of the rep associations with customers in the accounts. And Ed, is there anything you'd like to add to that?
Yeah, I'll just say that, as Tom mentioned, we're working with one of the large consulting firms and bringing some expertise in to help us think through that. But absolutely, we want to be very careful with how we think about the movement from hunting to farming and how we support customers going forward. The less breakage, the better.
Got it. No, that's helpful. And then just really quickly on Edgio, appreciate the color and the detailed guide. As we think maybe a little bit more longer term, given Edgio's out of the fold now and you have those contracts and assets, how should we be thinking about the pricing environment for the delivery, and can just having fewer players in the space help, maybe lead to a less aggressive pricing environment? Thanks.
Yeah, that really comes down to the different buckets of customers. I'd say with some of the larger high volume customers, we are seeing some rationalization to some extent, longer contract terms, which is helpful. Obviously, if you have less players, you do potentially have some better pricing, but we're already starting to see that in the market. So I'd say it's getting a little bit better, but it's always been a volume-driven business. So to the extent that volumes continue to drive, go higher, we'll still see, the general trend in pricing to go down. But hopefully, we'll see it moderate a little bit more in the future.
Wonderful, thank you.
The next question comes from John DiFucci with Guggenheim. Please go ahead.
Thank you. So Tom and Ed, I think this applies to both of you. Business looks to be going as planned, and we appreciate the 3 to 5 year goals. And actually all the information you gave us, this is great. But the guidance for next year implies 3% growth, and I think there's a 1% of FX headwind, so that's about 4%. I get the large customer issues, but there's always issues, right? That aside for now, how do we get comfort that growth is going to accelerate to 10%? Is it just math, because I haven't gone through it all yet, that the faster growing portions of the business will more than offset the delivery business? Or are you expecting improved macro backdrop in the forecast, or does it? I guess also related to this, does that 10%, eventual 10%, exclude any impacts from that large customer?
All right, so I'll take this one, Tom. So I'll start with the back part. The large customer, what we've done is we've modeled out what their minimum spend would be for that 5-year contract. So think of that as being the bottom of the potential there for that customer. So there's more upside there potentially. But in terms of what we're seeing for growth, I think you have to kind of break the business down into the buckets and why we showed you all that data. We'll start with delivery first. So delivery obviously has been a pretty big drag. It's starting to improve. We expect it to improve this year, continue to improve. So you should start to see some stabilization in delivery over that period of time, so that you think of that as that big drag sort of moderating significantly, so you don't have as much of a drag. So then when you take the businesses that we have, look at security. The bigger franchises are slowing a bit, but they're still growing. So we're still getting some growth out of that. And underneath that, say, for example, in our security products, we have new fraud products, and we're introducing new products. So that franchise will still grow, just won't be growing as fast as it was. But between Guardicore and API, those are very large markets. We have market-leading products. We think we'll be able to, that included with some of the changes we're making in go-to-market, the investments we're making in hunting, we'll get more productivity out of the sales force. And there's still a long way to go there. So we think that growth, as it gets bigger, and you get 10% growth out of security, that we think is pretty durable, given those factors. And then there's compute. So with compute, we're going through a little bit of a transformation, as Tom talked about, with the sort of I don't want to say the legacy, but some of the other older products in the other applications bucket, where we're partnering with some of the ISV partners, which has a little bit of a near-term flattening of revenue in that bucket, but it gives us a much bigger opportunity to grow the market by partnering with those folks, getting some of their own business, but also getting a product that's being invested in, et cetera, so we have a much more robust offering. And then, again, with the go-to-market investments we're making in compute, not only just with the hunters, but also with the overlay specialists, we think that'll also help drive more productivity in the field. So hopefully that answered your question.
Ed, that was really good. That's really helpful. It makes me think we need to do a lot more work around, especially compute, but it's exciting to think about Guardicore and API. I guess just one last question on the compute business. And one of the things that I can't help but think about here is profitability. And it's always a question in anybody that's coming into this business. But you allude to having some advantages entering this business, given the delivery business. I guess, can you describe that in a little more detail? I mean, I kind of get the high level. Is it as simple as you're utilizing underutilized assets across your network, or is there something more to it?
There's several reasons. First, we probably move around more data than pretty much anybody. And we figured out how to do that very efficiently. And so for customers of our cloud infrastructure platform, when they compare our pricing to the hyperscalers, we're a lot less, at least for the applications where they're moving around data, they got a lot of hits. And that's a lot of the applications out there today. And so in head-to-head competition now with the hyperscalers, we can offer a much better price. Second is performance. And, as we've talked about, we have the world's most distributed platform. We are in a position to get our customers' compute instances a lot closer to end users. And not only is that good for scalability, it's great for performance because the business logic is running close to the users. And so when we do head-to-head, trials now against the hyperscalers, for a lot of the applications, we perform better. So we're able to offer better performance at a lower price point. And now with the managed container service, that's super exciting. We can actually support our customers' containers in hundreds of cities. Nobody is doing that today. And so again, and those are locations we've had already, for the delivery business and the security business. So we're already there. So you get better performance and scalability at a lower price point. And then you combine that with the enormous market that we have a chance to tap into. And I think probably really important as you make the models to look at, our cloud infrastructure services revenue and what's happening there. We only really started selling that to enterprises last year. And went from very little revenue to 115 million ARR, and the total for our cloud infrastructure services 259 million, and we're projecting that total number to grow by 40%, at least 40 to 45%, this year. So I would encourage you to keep a close eye on that because that drives a lot of growth and profitability for us going forward.
Well, Tom,
John,
thank you.
Just to add on the profitability, there's four main synergies. One is the backbone, so we obviously can leverage that. Obviously, the contracts that we serve there. Number two is with operations, so a lot of the folks that build out the CDN also build out the data centers for our compute business, so we didn't have to go hire a big team. Number three is engineering. We talked earlier in the year that we moved about 1,000 people out of the engineering organization in our delivery business into the compute business, both in operation and engineering. And then the fourth thing is on go-to-market. so we can leverage our existing customer relationships and our reps, and we're augmenting that a bit with some of our specialists, but we don't have to go out and hire a whole new team. So there's an awful lot of operating expenses that we can take advantage of in terms of driving profitability.
Thank you, guys. This all makes sense. Now it's the easy part. You just have to execute. That was a joke. It's not easy.
Exactly.
Go ahead. Thanks, guys.
The next question comes from Patrick Colville with Scotiabank. Please go ahead.
Thanks for squeezing me in, guys. So I guess this one's for probably Dr. Tom and Ed. I mean, in the prepared remarks, you touched on, the reasons why compute would slow. But I'm going through my model now, and the year-on-year delta is pretty stark. And so I just want to make sure I've got them completely nailed down. So I guess just to start off, this year, 25% growth in compute. Next year, you're guiding to 15. Can you just double-click as to what is driving that?
Yeah, sure. So there's the two pieces. There's the cloud infrastructure security, which will continue to grow and actually accelerate. So that piece, it's the smaller piece of the two businesses, but that's going to accelerate pretty significantly. When you look under the covers of the application services, there's a number of things in there. For example, we have some of our legacy net storage business, which will be end of lifing that soon in the next year or two. And some customers will migrate to our cloud offering. Some may decide to do something else, but that's going to be in a bit of a decline. And then we've got a lot of revenue that comes from some of these potential ISV partners. For example, we've got some of our transcoding. We announced something with a partner called Harmonic, where we're partnering with them and we're migrating some of that business over there. They're using us now for their compute. So that's going to be shifting over time. And there's probably 4 or 5 different buckets, whether it's image manager, video manager, our waiting room application, or visitor prioritization. Those things we're going to be moving towards ISV partners and focusing more of our efforts on the infrastructure services. So you're going to see flattening to maybe slightly down in that bucket, and you'll see that most of the growth coming from cloud infrastructure services.
Okay, helpful. And then I guess there's a quick one, because I've been getting this a lot from investors. In terms of Akamai's exposure to the US Fed, how should we think about that and in 2024, and is there any expectations for that business embedded into guidance for 2025?
So when you say the U.S. Fed, are you talking about the Federal Reserve interest rate policy, or are you talking about the federal government? It's like selling to?
The latter.
Oh, okay. Yeah, so we obviously do sell to the government. It's not a huge portion of our business. It's way too early to tell with what the cost-cutting efforts that are going on, how that would impact us. But it's not an overly material part of the business, so I wouldn't expect anything material out of that. We haven't modeled anything material, just kind of regular way business for now. So I'm not anticipating anything.
Crystal clear. All right, thank you so much, guys. I really appreciate it.
I like that,
The next question comes from James Fish with Piper Sandler. Please go ahead.
Hey, guys. Appreciate all the details here and increased disclosures. I think investors will as well. Maybe just following up on something you just said first, Ed, can you just walk us through some of that transition impact on the compute side and which of the products you plan to sort of be transitioning off, and how to think about the utilization of the compute network today that we need to invest this much after 2 years of investing this much behind the compute business?
Yeah, so I gave you in terms of the investment, the percentage of revenue that we're expending for that. 1% of that of the 6 that we're using for compute will be specifically for that big customer. And I've always talked about how from time to time, if we do get large customers, you do tend to sometimes get outsized demand in a particular geo. We added an awful lot of investment this year in terms of bulking up the number of locations, et cetera. We're going to continue to add to those. We're also seeing very strong demand, so we're continuing to invest for that. But also keep in mind, we did migrate over $100 million worth of our own applications. It's running well over $500 million of our revenue today. And that business continues to grow. So we're still having to, provide some investment to support that, which is significantly less than what we would be paying if we were to continue to use third-party cloud providers. Now, in terms of the two different components of revenue, I think I discussed the cloud infrastructure service, so I think you guys get that. That's the real fast-growing stuff. And inside that other bucket is where you'll see that flattening out to declining, and it's really just the items I mentioned. We've got video management, image management, visitor prioritization, and some various workflow components like transcoding that we have built from time to time for customers. There's not a ton of demand for it. It's grown decently, but it's not a specialty of ours. So we want to make sure that we're investing in the right areas. So as we're migrating that partners and we shift our investment into the faster growing infrastructure cloud services, you'll see a bottoming out here this year, and then the growth will reaccelerate to 20%, led by cloud infrastructure services. And also keep in mind, I've got about, last time we broke it out, it was about 50 million of legacy storage. So I think of that as like the, media companies storing, like a backup origin for their, video files and music files and that sort of stuff, images, etc. That business will be winding down over the next year or so. So that's going to have a bit of a drag on revenue as well.
Understood. And I think a lot of investors here, you guys are sitting here on an earnings call giving a 3 to 5 year framework. The last time we got this type of framework from you guys was many years ago. And I think in that framework, we had talked about, a 20% constant currency security growth, for example, and we didn't hit that. So you're talking about a 10% CAGR that includes M&A from here within security. And just, what's going to drive the reason that we actually achieve these results, and that this is, a reasonable expectation that actually might be conservative, as opposed to, hoping that we hit that number. Thanks, guys.
Well, I mean, to be fair, there were several years during that period of time when we did grow 20%. We always said 20% would include acquisitions, and we did some acquisitions along the way. We just did put up 16%. So that business has been very healthy. We've been adding a couple $100 million of high margin security revenue for years now, and if you do the math, we'll continue to do that. In terms of the impact of acquisitions going forward, we're not anticipating doing significantly large acquisitions, more of what we've done in the past, whether it's tech tuck-ins or smaller companies that are, got a product that's in market that's about to scale, like API security, where, the company's looking at making a big investment and go to market, or, raising a round or looking to exit. We buy something like that, or like Guardicore, we scale that up, and we've shown that we've got success there. So I think we've got confidence in our M&A strategy. It's not going to be a significant portion, but maybe over time it might be one of the faster growing products as we exit the decade. And what we've been able, why we broke these businesses out for you can see how well we're scaling a business now that's a couple $100 million, growing extremely fast. So, I think we have pretty good confidence. And again, we can quibble over the 20%, and maybe a couple of years we're in the high teens, but as we said, that would have included acquisitions and always do them. But I thought we did, pretty well over that period of time. And we just thought, now that we're getting to a scale of a couple of billion, it made sense to update expectations as we see some of our products that we've been in the market for over a decade slowing down.
The next question comes from Will Power with Baird. Please go ahead.
Okay, great. Hey, Tom, you provided some good examples in the prepared remarks, I think, of some of the applications that are being used in your network. I mean, it seemed for some time that you should be well positioned for inference, at the edge. And I wonder if you maybe update us just as along the lines of, the tone of conversations you're having, what kind of the pipeline looks like, just kind of the activity level you're seeing in terms of taking advantage of, particularly some of these generative AI applications and inference that maybe is starting to develop, or you at least think is going to start to develop.
Yeah, I think there's a lot. AI-powered ad image normalization, so that the various images have the same consistent size, quality, image classification, even for things like detecting disease in crops. AI-powered speech recognition in cars, AI-powered chatbots, sentiment analysis, text-to-image inferencing for a variety of applications. All sorts of applications already using Gen AI on the platform. And, we have partners, our ISV partners. Some of them, doing AI on the platform, WebAssembly, AI inferencing. So I would say it's early days, but all sorts of things being done on our, cloud infrastructure services today.
Okay, and then as we look at the cloud infrastructure assumed acceleration, I think you're looking for 40 to 45% ARR growth. Any further breakdown? How much is inferencing influencing that, or is that still early? And if not, what are kind of the key drivers of the acceleration there, including impact of the $100 million deal? How does that factor in?
Yeah, the $100 million deal doesn't do a lot this year. That doesn't really ramp up until the end of the year. So I don't think that's a material impact on our 40 to 45% projection. That'll certainly help us in 26 and beyond. And I don't think, AI inferencing is a big part of the growth this year either. There could be some, but I think that'll fall more into the upside category. I think it's just more the traditional uses of compute, on the platform. And, keep in mind, that's a $100 billion market today, plus, without getting into AI or the new large deal that we've done. And just as examples, with our ISV partners, database at the edge, observability for all sorts of applications, media workflow, things like file transcoding and live encoding, video packaging, interactive web RTC. These are what our ISV partners have their applications doing on our cloud, infrastructure platform. Digital asset management, video optimization, game orchestration, fleet management, DRM, Kubernetes, activity and auto scaling, ad insertion, server-side ad insertion. So there's just a bunch of stuff that it's just good old regular, compute that's, running on the platform. I would say we're, as you can see from the examples we've given, we're selling it into pretty much all the verticals. A lot of financial companies are starting to use it now. Media, broadly construed, is still, I think, the sweet spot, and partly that's by design, because those customers need to get great performance. They need to cut costs. They don't like writing a huge check to their biggest competitor. And they're big Akamai customers, and they like Akamai a lot. So that's sort of the center of mass, but it goes across verticals and across a lot of use cases. And I'd say we're excited about AI. That's upside and probably comes down the road.
That's helpful. Thank you.
The next question comes from Mark Murphy with JP Morgan. Please go ahead.
Oh, thank you very much, Tom. Interested to get your view of the ramifications for Akamai of all of the technological advancements and efficiencies that we've seen with the DeepSeek model, and whether you see any signs of that opening up kind of a broader wave of experimentation on, for doing edge inferencing on Akamai compute. Maybe some of those AI applications are going to become more economically viable. And then I had a quick follow-up for Ed.
I think the DeepSeek phenomenon or announcement, whatever you want to call it, is very consistent with what we've been saying is going to happen. I think you'll see further improvements. It's great for us because it validates what we've been saying and how we've designed our cloud infrastructure platform. In fact, there's already entities running DeepSeek on our cloud infrastructure platform, along with other models. And it does mean that it is a lot less expensive. It doesn't need, the giant core GPUs. It can be run on, lighter weight GPUs. There'll be a lot of use cases where you want that, on the edge. And I think it's great and very much what we expected to happen. And I think you'll see more developments along those lines.
Okay, that's great to hear. And Ed, as a follow-up on the security CAGR, where you're expecting about 10% the next 3 to 5 years, that's fairly close, I believe, to the overall market growing something like 12 to 14%. and you said that it includes a typical level of M&A. If we think about it organically, should we pencil out something like, maybe mid to high single digits organically, and then if you're able to find some of these tuck-ins, you've done an incredible job picking those out and executing on those recently, and they're growing like a weed. Then maybe the inorganic piece gives you a few points there over the next 3 to 5 years. Is that a decent framework?
Yeah, I think that's a good way to think about it, Mark. I mean, obviously, at the scale we're at now, over $2 billion, and we talk about even the bigger revenue companies we've acquired have been 20 to 30 million. That's insignificant. It's about a point in total from inorganic. In terms of the near term, there's going to be mostly from organic. But yeah, probably maybe 1 point, something like that, as you get out a couple of years. And then obviously if we pick a good company like we did with No Name or like we did with Guardicore, as you get out further, we consider that organic growth at that point. That might be contributing because it's a faster growing area if we get into a hot space that's growing quickly. But in terms of to make a number in any given year, we don't anticipate getting much more than maybe 1% from an acquisition inorganically.
Okay, understood. Thank you so much.
I understand that we have time for one last questioner, and that will come from Jonathan Ho with William Blair & Company. Please go ahead.
Excellent, and let me echo the thank you for the additional disclosure. Just one question from me. How concerned should we be with potential tariff impacts, and can you maybe pass through higher costs that are associated with that? I know you're trying to maybe accelerate some investment ahead of time, particularly given your need to invest on the compute side over the long run. It does seem like there's maybe some exposure here. So just wanted to understand the implications there. Thank you.
Yeah, I mean, it's obviously tough to call, just given we don't know what the ultimate end game is here in terms of towers. But to the extent we do have the ability to move supply chains around, and we're looking at obviously doing that. There was some talk about Canada and Mexico. We do get some server builds out of there, but so we fast forwarded some. I gave you the number, 10 to 15 million, so it's not significant. In terms of can we pass some of these pricing costs along, we're certainly exploring that as part of the work we're doing with the consulting firm we hired. Overall pricing strategy is part of it, and to the extent that it becomes somewhat material in any way, we certainly would have to bake that into our pricing. But it's tough to say at this point because we just don't know what the final end state is.
Okay, that's that.
Thank you.
All right, so I need to go
This
eat.
concludes
So
our
I'm
question
gonna-
and answer session.
Yeah, I need to go eat. I'm kind of hungry before I go climb. So I think I'm not going to stream this part, but I also want to listen to Unity. Unity's up 30% today after they reported earnings this morning. So I want to go check that out, and I'll see you guys in the next one. I just realized I'm not even on the YouTube, so okay, peace.